Episode 1. The number 1 has lost some meaning in medicine. It used to be that after 1 year of residency training after medical school, one got a general license to practice. Now, that was abolished in the early 1990s, and now it takes anywhere from 2 to at least 5 years to complete your training after medical school. And that doesn't include fellowship. So it goes without saying that physicians begin earning later than many others. Which is why I think it's even more crucial to have a fundamental understanding of certain financial concepts. All right, episode 1, here we go. Okay, so today we begin our journey through the topic of corporations. As with all subjects on this podcast, we will begin with more basic concepts, and subsequent episodes will dive into greater detail. Today's show is also going to be relevant to professionals outside of medicine. Okay, Corporations 101. What is a corporation? It's a business entity through which you conduct your professional services. How do you open one? You can go to an accountant, a tax lawyer, or seek an opinion from both. Okay, so the money you earn is going to flow into the corporation. What do you do now? You have to pay yourself. You can do that through salary, dividend, or a combination of both. It's not too complicated. Basically, you want to pay yourself enough salary to free up some RRSP contribution room. And if you pay yourself enough salary, eventually you'll fall below that $500,000 small business limit. So corporate income below that limit is taxed at 12.2%, anything above 26.5%. These are Ontario values, and other provinces will be similar. Just remember that salaries reduce the amount of taxable corporate income, whereas dividends do not. Okay, so you've paid yourself throughout the year, and at the year end you have money left in your corporation. What do? You go ahead and invest it for the future. If you understand this, you already know more than I did when I started practicing medicine in 2016. Now, that is a very basic overview of corporations. To help us dig a little bit deeper, we have the first guest on the show, Ali Spinner, who is a chartered accountant, a partner in tax at Crowe Soberman. Ali has given numerous lectures, sits on several boards, and has 19 years of experience in personal and corporate tax matters. Here is our interview. Hi, Ali. Welcome to the podcast. Where does this podcast find you?
Well, thank you for having me today. I'm very excited. Well, the podcast finds me today working from my home office in Midtown Toronto, I guess North York, looking out on a bright, sunny day, enjoying these dog days of August.
Let's just jump into it right away, and I'll bring up the question that I think every new physician has on their mind when starting practice, and that is, if one expects to save some money every single month, should that individual, as a physician, go ahead and incorporate right away? Is it a no-brainer?
That's a great question. I don't think it's necessary that the physician incorporates right away, and I'll explain why. So, if I can maybe take a step back and just talk about a big picture regarding incorporation,
Hmm.
keep in mind the benefits of incorporation are that our tax deferral.
Yep.
So an individual I'm going to use Ontario rates, for example, because I'm most familiar with them. An
Uh-huh.
individual in Ontario earning more than about $225,000 pays tax at about 53.5%. So at every dollar, you're paying 53.5%. To the extent you have the ability to earn that money through a corporation, you are able to pay a lower upfront rate of tax.
Right.
The corporate rate of tax is 26.5%.
Yep.
And if you are able, some doctors may not, but if you are able to avail yourself of the small business deduction on the first $500,000 of profit, subject to some clawbacks, which I'm sure we'll get into, you actually only pay 12.2% tax on the first
Hmm.
$500,000 of profit that you can leave behind in the corporation, which I will explain.
Yep.
And there beyond, if you're subject to the clawback or if your profit that you're leaving behind is beyond $500,000, you're at the 26.5% rate.
Right.
So without a doubt, everyone would want to say, yeah, sure, I want to pay less tax. There's no question. I don't want to pay 53.5. I'd rather pay 12.2 or 26.5. But the question becomes, how much money are you not spending? And I think, you mentioned this when you asked the question,
Hmm.
if they're saving a few dollars every month, does it make sense to incorporate? The question is, how much are you saving and what are you planning on doing with that money?
Right.
So if you're saving $5,000 a month, $10,000, well, 10,000 we'll get to. But if you're saving smaller dollars, then yes, while you will have some absolute dollars in tax savings if you
Hmm.
leave money behind in your corporation, we have to keep in mind that introducing a corporation to the structure, of course, comes with some professional fees, and so you
Right.
have to you have to balance the cost with doing so along with the deferral that you're getting.
Hmm.
And we have to keep in mind also the benefit of incorporation is really, yes, it's tax deferral. And let's assume for a moment that if we're making more money than we need to live personally,
Uh-huh.
and if we can leave money behind, we're going to invest that money. We're going to
Right.
invest that money for our retirement generally.
Right.
And so the beauty of investing the money in the corporation is that, let's assume for the moment that you are able to benefit from the small business deduction.
Uh-huh.
You are able to invest what I call 78. I'll forget the decimal points for a minute. It's not even 78. 88. 88 cents on the dollar you're able to invest, versus if you had that money personally, it's 46 and a half cents on the dollar you were able to invest.
Right.
So the question becomes, should I incorporate? Well, the question becomes, how much, it's a little bit confusing, but how much of an increased differential are you able to earn on the funds that you can leave behind in the corporation to earn investment income?
Hmm.
And the point, I know I'm throwing a lot of numbers. The key is the dollar amount that you're able to save large enough
Hmm.
that the incremental savings outweigh the professional fees.
Right.
It's a very long way of it's a very long way of saying that generally, if you're saving about $100,000 per year, there's not
Yep.
necessarily a magic number, but if you're saving about $100,000 per year, then sure, I would say the savings or the deferral would outweigh the costs
Hmm.
of setting up the structure and maintaining it. And this would be something that will be beneficial in the long term.
Okay.
If I can add one other point,
Yep.
when I mentioned money that we need to live off of, keep in mind, savings to me doesn't mean, if you have a large expense coming up in 3 or 4 years, perhaps you know you're going to have to pay for a child's education, or you're going to want to buy a cottage, you're going to have to pull that money out of your corporation in some fashion
Hmm.
at that point in
Hmm.
time. So keep in mind that the savings here are very short term.
Right.
um, as part of the tax environment that we're in, when you pull those dollars out of your corporation that you otherwise left behind in the year that you made the money,
Yep.
you're bringing yourself back effectively to that 53.5% tax rate.
Right.
So that's why I mentioned this is deferral,
Yep.
not savings.
Hmm.
So you have to keep in mind, are you making well enough money that you're not going to need it, this year and the next few years? Because if you're going to pull it out anyway, perhaps the amount of income that you can generate on the deferral may not be worth it in the short term.
Thank you, Ali. I think that's a really good introduction to corporations. There's a lot of information there that we're going to be digesting as the interview goes on. Now, I really want to move on to the next point, and that is of income splitting. And I think most of us are aware that in the last few years, the rules governing income splitting changed in the sense that it's not as easy to shift money to family members now. So let's say one is a physician and your spouse is not yet 65 years of age and you don't have kids who are yet 18 years of age. What can you please speak to legitimate avenues that currently exist to shift money from the corporation to family members?
So referring to income splitting opportunities. So you're absolutely right. It used to be a much different landscape. Effectively, if you had major children as well as a spouse who wasn't earning income, you could save approximately $25,000 per year by I don't want to say diverting income perhaps, but maybe sharing income amongst those different family members. And absolutely, it's been about 3 or 4 years now that we are in under a new landscape where
Hmm.
that's no longer permitted. So the methods of income splitting are actually quite limited now. One example that's pretty vanilla,
Uh-huh.
quite straightforward, is the use of a prescribed rate loan.
Okay.
And it's nice that we're talking about it now because the current interest rate on prescribed rate loans are 1%.
Hmm.
Now this doesn't necessarily this is available to everyone, not
Okay.
just the physician with the incorporated practice.
Okay.
The reason being that in this situation, If the physician is the one who's been earning the money and they have excess funds left over and they're investing those funds,
Hmm.
and perhaps if their spouse or their minor children do in this case it can be minor children, doesn't have a source of income,
Hmm.
that physician can make a loan either directly to their spouse or to a trust in favor of their children,
Okay.
and that loan would bear interest at currently 1%. It's
Okay.
really the lowest that it's been ever.
Right.
That loan could bear interest at 1%.
Hmm.
And then the investment portfolio that is, so the loan would be invested in an investment portfolio.
Hmm.
And the reason that this is an income splitting process is that the rate of return that is earned by the investment portfolio in excess of the 1% that's paid back on the loan to the physician,
Yep.
the delta there is taxed in the hands of either the spouse or the children.
Okay.
So it's a very common for high net worth individuals who have the ability to build up after tax money, not in a corporation but in their personal hands. It's a
Hmm.
very common way to split income amongst family members.
Okay.
I would say in this case, you really do need a substantial amount of money to make the plan work.
Okay.
And I would even say that you need probably at least $500,000 or so to make that initial loan to make the plan worthwhile. So that's prescribed rate loan planning. Back to the corporation and talking about income splitting strategies.
Hmm.
If you had a, you can still pay reasonable salaries to family members to do work that they're actually doing. I mean,
Yep.
sometimes clients or individuals will call me up and say, "Hey, Allie, how much can I pay my husband out of my MPC?" And I'm like, "Well, how much work did your husband do?" They're like, "Well, nothing." I'm like, "Then the answer is nothing." There's no like magic number where the CRA has
Right.
secretly blessed that you can pay your spouse 20,000. There's nothing like that. So the answer is you can pay an individual, even if they're related to you, a reasonable amount of compensation
Yep.
for the work that they perform. So that means whether you have, family members helping out in your office, helping out with billing, helping out in any other administrative, I don't think that they're going to do like OR assists for you, but in any other capacity that they can, certainly you can pay them a reasonable salary for that type of work. Beyond that, there is no other magic bullet that comes to mind.
Okay.
You did one thing that you did mention though that is important is you mentioned about spouses if the spouse is less than 65. The nice news is that there's still there still is merit in setting up these structures with having spouses own a class of shares
Okay.
that entitles them to a dividend,
Okay.
because the good news is that once you turn 65 years old, you are able to continue, or not continue, you are able to pay dividends for income splitting purposes to your spouse on
Okay.
that class of shares
Hmm.
that are not caught up in these quote unquote bad new rules.
Gotcha.
So even though while in your income earning years you may not be able to split income with your family members, the nice thing is that in retirement, if we go with the standard age of 65 for a moment,
Hmm.
in retirement you are able to pay dividends on shares that are owned by your spouse
Okay.
once the doctor is now 65 years old.
Okay, great. So while we may be a little bit more limited than before, it sounds like there still are a few legitimate ways to move money from the corporation to family members. And Ali, just as a follow-up question, for the prescribed rate loan, the spouse does not need to be a shareholder of the corporation, right?
No, no, the prescribed rate loan has nothing. It's completely distinct and separate from the corporation.
Okay, I'm so happy you said that because my wife is not a shareholder of our corporation, so we're all good to go there. Okay, the next question is on salaries versus dividends, and I can tell you that I drove my accountant totally nuts on this one because I was always so preoccupied with how do I best pay myself? Is it a salary or a dividend? And he kept telling me, dude, it doesn't matter. And he spelled out the priorities for me, which I think makes sense now. And those were pay yourself enough salary to get yourself below the $500,000 small business deduction. And if you're trying to buy a house in the near future, well, you want to pay yourself some salary to establish a credit history. But I'm wondering if you can just speak. in a little bit more detail to shed some light on the salary versus dividend debate?
That's a great question. There's a lot to unpack there, so I'm going to try to go through it piece by piece. My general rule of thumb is as follows. Generally, when I have individuals who are earning money through their corporations, like an MPC,
Hmm.
I generally encourage that the first about $150,000 that they take out of the corporation should come out by way of salary.
Okay.
The reason why I want them to take it out by way of salary is I want to make sure that they maximize their RSP contribution room
Uh-huh.
to give them, even if they say, well, I'm not sure if I want to make, you never know. So I'd like to make sure that you still have the option of being able to maximize your RSP contribution room, even if you're not going to make an RSP contribution for that year. You may decide in a future year that you want to do a catch-up payment.
Okay.
So $150,000 seems to be the magic number.
Hmm.
And it is true, you will also, at $150,000 of salary, you will maximize your CPP.
Yep.
Um, and even though, to high income earners, the CPP is a bit of a drop in the bucket, it's still a nice to have one day when you're, let's say 71 years old and you've pushed your CPP out as long as you can and it starts to come through. It's still a nice to have.
Hmm.
Now, the truth is, what your accountant told you is absolutely correct. It really, really doesn't matter from a strictly tax point of view
Uh-huh.
whether you take the money out as a salary or a dividend.
Okay.
I can tell you I've done the analysis for myself, and I do every single scenario, and I do every permutation and combination,
Yep.
and the amount of difference is negligible. The
Okay.
amount of difference is negligible, which is why I practically, usually with clients, we set them up on a salary of $150,000. They know how to make their source deductions each month. They're on a set plan, and then we usually tell them, and then as you need money out of the corporation, you simply take that money out. You
Okay.
simply take it out to yourself. And at
Hmm.
the end of the year, we record it as a dividend.
Sure.
From a tax point of view, um, the delta between coming up with a more precise number is just not going to be worth the analysis.
Okay.
And then furthermore, one other thing I wanted to come back to was your comment about the small business deduction and $500,000. So it's interesting. The quote unquote bonus down to $500,000
Hmm.
is it's kind of old language.
Okay.
It used to be that if your income was above $500,000, you would end up with a clawback in Ontario
Okay.
as a result of your income. That clawback is no more. We now have different clawbacks. We have different clawbacks as part of the same regime that we are in now, whereby we cannot pay dividends, or we can pay the dividends, they would just be taxed at the very highest marginal rate. But this
Okay.
concept of paying dividends to children or spouses
Yep.
also came out, this new set of rules whereby the ability to claim the small business deduction gets ground to the extent that we have significant investment income in a corporation.
Right.
So I believe that if you have $50,000
Yes.
of passive investment income in your corporation,
Yep.
you start to grind your federal small business deduction.
That's right.
And when you get to $150,000 of passive investment income, I believe you've completely ground it. Um, it's true that Ontario didn't follow suit, and so there's a slightly in between rate for the small business deduction, which is slightly better. It's beyond the scope of worrying about it for right now.
Uh-huh.
But generally, my rule of thumb is I don't worry about quote unquote bonusing down to the
Okay.
$500,000. It's not relevant. It's not relevant to me. The key is generally paying yourself the $150,000 salary, take
Yep.
everything else that you need out as a dividend.
Hmm.
And if you don't need the money, don't take it out.
Okay, Ali, that makes so much sense. And I wish I talked to you before driving my accountant totally nuts. So let's say now, after a combination of salary and dividend, one has some retained money inside the corporation. Ideally, one would like to invest that income, but I think
Mm-hmm.
to invest that income properly, one needs to really understand what makes up passive income, because
Mm-hmm.
my understanding is that passive income is taxed at essentially the highest marginal rate. So
Mm-hmm.
let's give or take 50%. So maybe we can just break down what constitutes passive income.
Sure, that's a great question. And you are right. So passive income, which is effectively investment income,
Yep.
passive income, which is investment income, is taxed at a corporate level such that there is no deferral play. And what I mean by that, uh, people might ask, is it better for me to earn, or is it better for me to have an investment portfolio in my personal name or through my corporation? The answer is it's so immaterially different, it doesn't matter.
Okay.
Sometimes, depending on which way the tax rates move, it becomes more advantageous one way or the other.
Hmm.
We're in a regime right now where the delta is very small.
Uh-huh.
So what that means when I say there's no deferral is that, as I mentioned before, if you earn $1 of income personally, which includes $1 of passive income or interest income, you will pay tax at 53.5%.
Right.
If you earn that dollar of interest income in the corporation, because the government does not want you to be able to defer taxes by earning investment income in a corporation, you will pay, it's actually 50.17% tax.
Okay.
So there's that, that delta between the 53 and the 50 is pretty small.
Right.
And what's baked in to that 50.17% tax
Hmm.
is this component of taxes that are called refundable taxes.
Okay.
I'm not going to get into the whole refundable tax regime other than when the corporation pays a dividend out of its passive income
Yep.
to the shareholder, a
Hmm.
portion of those taxes are refundable.
Okay.
And then, of course, the individual will pay tax on the receipt of the dividend.
Right.
It's part of our tax integration system. But let me get back to your original question. Passive income includes rent, royalties, dividends, interest, capital gains. Of course, with capital gains, right now the inclusion rate is 50%. So capital gains are only half taxable. So um, the key with passive income and saying, well, where should I invest?
Hmm.
Because the tax rates, whether you earn income through a corporation or personally, are quite aligned.
Uh-huh.
I would really say that I don't like to let tax wag the dog.
Uh-huh.
And I really would, obviously, of course, the question of what should I invest in is best answered by an investment advisor.
Right.
But generally it's a regime of you're not going to invest based on tax impact. Of
Right.
course, tax will factor into it
Hmm.
because it'll have an impact on your overall return.
Hmm.
The one piece of advice that's important that sometimes people forget is that if you have a foreign stock, so let's say you own shares of Coca-Cola,
Uh-huh.
if you have a foreign stock in your portfolio in a corporation, the integrated overall effective rate on the dividend, and
Uh-huh.
to be fair, I don't even know, maybe I don't know if Coke pays dividends or not, but
Oh,
if
it
you have a
does. It does.
dividend paying if you have a dividend paying foreign stock, the integrated rate on the tax rate on that dividend, and when I say integrated rate, I mean the corporate tax plus the personal tax
Right.
when you pull that dividend out of the corporation eventually,
Uh-huh.
is actually about 9 percentage points higher. It's
Okay.
about 62%.
Oh, wow.
There's a funny calculation with the impact of the foreign withholding taxes on the dividends
Okay.
that are paid to the United States government
Uh-huh.
and the impact that they have on the refundable tax regime in Canada. So
Okay.
sometimes people forget that point.
Hmm.
And again, like it's interesting. I've had many conversations with investment advisors because as part of a proactive, tax efficient a holistic approach, it's important that the wealth advisor speaks to the tax advisor to make sure that we're if we have a choice of, well, should I invest through this in my corporation or in
Uh-huh.
my RSP or in my non-registered account, it's important that it gets taken in. But again, it's one of those things where, yes, the extra 9 points is important.
Yes.
But again, we don't necessarily want to let tax wag the dog here. Even if there's an extra drag of tax on the dividend income, there might be very good reasons to still make that investment.
Right.
And it's important to be aware, and that might be more relevant in determining, well, which which entity should hold which type of investment.
Okay, so that's a very helpful discussion. So we used a US company paying a dividend as an example. And it sounds like the tax that you would pay on that foreign slash US dividend would be fairly significant. But let's contrast that now to a dividend that will be earned from a Canadian company. It sounds like to me that the tax that would be paid on that dividend earned by the Canadian company would be less.
Mhm.
Maybe let's talk about that a bit further.
Well, it's an interesting point. So let's just take that a little bit further. So let's talk about first in your personal non-registered portfolio.
Right.
If you have a dividend paying foreign stock, well, if it's foreign, that's an important consideration. If it's foreign, you're going to end up paying 53% tax.
Uh-huh.
Foreign dividends don't get the benefit of eligible dividend
Uh-huh.
treatment, which we'll talk about in a moment. Foreign dividends don't get the benefit of being treated as an eligible dividend.
Uh-huh.
So foreign dividends are taxed at 53.5%.
Okay.
And yes, you will get credit for the 15% tax you would have paid uh, to the foreign government on the withholding taxes, but you're still going to end up being paying, when you add up all the global taxes together, it'll still end up being 53.5%.
Right.
If you invest in a public Canadian corporation,
Yep.
then, and if we assume that those dividends that are being paid are what's known as eligible dividends,
Uh-huh.
and you invest in your own personal portfolio, a non-registered account, the tax rate on that would be about 40%.
Okay.
So that's a very large difference, the 53.5% on the foreign dividend versus foreign 40% on the Canadian dividend.
Right.
That is significant. And as well, what if that Canadian dividend was earned through the corporation
Right.
and then paid out of the corporation,
Yep.
again, because of tax integration, we should be back to the 40% tax
Okay.
overall.
Okay.
But again, with the foreign stock and the dividend being paid, once we funnel that money through, we're
Mm-hmm.
probably close to about 62% tax again.
Okay, that's helpful to know that there is a difference in how foreign dividends and Canadian dividends are taxed,
Mm-hmm.
whether it's personal or within a corporation. I was not totally clear on that. And one other point I do want to clarify, and it's because some of us do hold whole life insurance policies within our corporations,
Mm-hmm.
and I don't want to get into too much detail because whole life insurance is a whole other episode. But how are the gains through a whole life insurance policy taxed?
It's a great question. It's a great question. And many medical professionals do hold whole life. Some of them hold it as an asset class. This is
Hmm.
getting into insurance as an asset class at some point in time. Um, so the way that insurance is taxed is that it's really not.
Okay.
Is that the insurance policy grows in value. The gains within the policy are not taxed at all.
Wow.
And the beauty of insurance is that when the life that is insured, when that person dies,
Hmm.
the insurance proceeds come into the corporation
Yep.
and can be extracted from the corporation tax free
Okay.
through the corporation's capital dividend account.
Okay.
There's a special magic account in corporations called the capital dividend account
Right.
that allow, and really from our perspective, there's really two pieces that fill up that capital dividend account that allow these tax-free dividends to be paid. One of them
Hmm.
are the proceeds from life insurance policies, and the other, of course, is the non-taxable 50% of capital gains that we realize in the corporation in our investment portfolio.
Okay.
So the neat thing is with insurance is that the proceeds of the life insurance policy in excess of the cost base of the policy, which is
Uh-huh.
important, I'll come back to that, the delta there flows into our capital dividend account and can be extracted tax-free.
Okay.
I will mention that there was a change. Of course, there's always a change. There was a change in legislation a couple of years ago,
Yep.
whereby the amount of the life insurance proceeds
Yep.
that can be put into the capital dividend account
Hmm.
changed. Um, it, and effectively, the the long-term view is that effectively, if you hold a policy for a very, very, very long period of time,
Right.
and you buy the policy when you're young, and
Hmm.
then you pass away when you're 90 years old,
Hmm.
you will get a very large addition to your capital dividend account because over time, the delta in the fair market value of the policy over the cost base of the policy,
Hmm.
the amount becomes larger and larger. If God forbid you purchase a policy and die suddenly, the amount that gets added into this capital dividend account may not be as large as it otherwise could be. But
Okay.
but generally we think of life insurance, both the growth within the policy as
Hmm.
well as the payout of the policy,
Hmm.
to be tax free.
Okay, great. So this corporate capital dividend account, Just to clarify, this is not
Mhm.
something on paper, right? This is just an account that is somehow embedded into the corporation, right?
That's why I said it's magic. It's a notional tax account. It's a notional tax account. It's a notional tax account. It's a running balance.
Hmm.
It's a running balance. If you have a corporate tax return, the CRA finally included a schedule. It doesn't get filed with your tax return per se, but it's in the tax software
Okay.
called Schedule 89.
Yep.
And this is a notional account that gets built up. It gets built up and depleted for various reasons.
Hmm.
The most common one that we see is the non-taxable portion of capital gains.
Okay.
So that's how if you buy a stock with all
Right.
of the money that you can save with
Yep.
your investment portfolio, you buy a
Yep.
stock for $100. It grows to $1,000, and then you decide, oh, I want to buy that cottage, and you say, okay, I'm going to have to take this $1,000 out of my corporation. I'm going to have to sell that stock.
Hmm.
When we sell the stock, the $900 gain is only half taxable. Half of it comes out as a taxable dividend, and the non-taxable portion of the gain
Right.
goes into this magic account called the capital dividend account.
Okay.
And then, of course, you need your accountant and your lawyer to do a little bit of paper to allow you to make an election
Okay.
to pay out this capital dividend account. You actually have to file the special election with the government, allows you to access it. And that's how you get the non-taxable piece out. Because of course, if we didn't have the special account, we would have to take the non-taxable piece out of the corporation
Right.
as a taxable dividend, which wouldn't make any sense because we would not be preserving the nature of capital
Right.
gains being half taxable.
Now, Ali, I'd like to move on to RRSPs, and I know you already touched on this briefly earlier, but I'll preface it by saying this, that I know many physicians who actually don't have RRSPs, and basically I view corporations and RRSPs both as tax deferral vehicles. So the question becomes, does one take all that money out of the corporation and move it into an RRSP, or does one simply leave the money in the corporation and invest that money through their corporate investing account? This may be one of those scenarios where it may not matter all that much. I suppose when we look at the passive income rules in a corporation, in that once one is earning more than $50,000 of passive income per year in the corporation, that can alter the eligible small business deduction.
Mm-hmm.
But perhaps we can just talk a bit more about RRSPs and their utility when one is incorporated.
So I think it's an excellent question. I do agree with you. It's a bit of six of one, half a dozen of the other, in that it doesn't really matter. However, I will say forever and ever and ever, the school of thought was you absolutely max out your RSP. You absolutely max out your RSP. Like
Hmm.
people did studies and analyses. Um, and I give credit to Jamie Golenbeck, who's a contributor to the National Post, and
Uh-huh.
he had his team run. And if you Google, you can find the analysis in the article. Probably
Okay.
about 5, 6, 7 years ago,
Yep.
they ran all the numbers and they realized, whoa. Wait a minute. We've been telling everybody to contribute to their RSPs,
Uh-huh.
but if you actually go back, I think his conclusion was if you're young enough, if you start young enough, so probably around, it was about 35 years old, if you start young enough and and you leave the money behind in the corporation,
Right.
you were actually ahead by not making RSP contributions.
Interesting.
But then with the change in rates and everything else, he's
Yeah.
now back in the camp, and I know Jamie well, and I've heard him say this a number of times. He's now back in the camp that
Uh-huh.
it still makes sense that you will always be, and it might be slightly, but you will always be further ahead by making the RSP contribution.
Okay.
That being said, some people love RSPs, some people don't. The reason that people like them is that it's a way of almost forced saving, if
Hmm.
you will.
Yep.
If you know that you're committed to making your RSP contribution, you're going to save up a significant amount of money available for your retirement. And it's kind of like locked away. You can't touch it. You don't
Right.
think about it. You don't think, oh, there's just some money here. I'm going to take it and buy a new boat for the cottage.
Right.
Um, the money's away. So I like that aspect. The other aspect of what I like about it is that it does have an extra layer of creditor protection.
Uh-huh.
And again, I'm not a lawyer, I'm not giving legal advice, but my understanding is that money in an RSP has an added layer of creditor protection versus money that you otherwise would have in the corporation
Okay.
or not. So that
Okay.
might be enough. But the downsides, I would say, of the RSP is what, or I should say, what the downside of the RSP and the beauty of the corporation is that having money in the corporation, what I always describe to clients is you can turn the tap on and off with full
Right.
flexibility as to when you want to stream money out
Right.
and pay yourself dividends in retirement. With an RSP, when you turn 71, you are absolutely mandated and forced to take money out of the RSP
Right.
into your income at a prescribed minimum rate because
Mm-hmm.
you have to deplete it over your life.
Mm-hmm.
Whereas with a corporation, there's no rule that says you must take the money out.
Uh-huh.
So some people like the flexibility of having the money in the corporation. It certainly gives you more money. Sorry, it gives you more flexibility
Right.
in retirement
Yep.
to determine how and when you take funds out of the corporation.
Mm-hmm.
That being said, what sometimes people forget is that in retirement, you still want to make sure, especially if you've been, a diligent saver and you've built up a significant investment portfolio,
Mm-hmm.
even if your needs in retirement are very small, you still want to make sure that you're using up your marginal rates of tax.
Mm-hmm.
As I mentioned at the beginning of this, you only pay 53% on $225,
Yes.
and the tax savings as you go up through the marginal rate are about $25,000 in absolute dollars in today's dollars. So maybe having the RSP and having to pull out money isn't so bad anyway, because I generally want my clients who are worth a few bucks to make sure that we're keeping their income at
Mm-hmm.
$225,000 in retirement, even if they don't need the money,
Mm-hmm.
to make sure that we're using up that $25,000 marginal rate tax benefit each year.
Mm-hmm.
But that's my answer. Is it probably doesn't matter. Personally, I like the forced savings.
You could have left it at it doesn't matter, but you went ahead and picked a side. I appreciate that, and I'm sure our listeners will as well. Okay, I'd like to probe this topic a little bit further and also bring COVID into the discussion. And correct me if I'm wrong, but when you look at corporations that qualify for that small business deduction, that rate of 12.2%, corporations in that category in Canada, it seems like for a number of years have benefited from a relatively low tax rate. But with COVID and the impact on the economy and all that spending by the government, one has to think that at some point the tides may turn and that individuals and corporations may down the road be hit with a significant hike in tax rates. And if that's the case, then that strengthens the argument for RRSPs. I'm wondering if you have any comments on that.
If I knew the answer, I'd be a very wealthy woman selling my predictions on the corner. The truth is, I don't know. I definitely know that some advisors or some tax practitioners thinks that rates are going to rise. I'm of the view that I'm not convinced. I could certainly see something like a consumption tax, like a GST rising, and that wouldn't surprise me because that really targets, those who can pay to consume things. Um, that certainly places a targeted approach on who is going to pay the tax. So that would not surprise me, some sort of GST, addition to the GST.
Okay, let's continue on COVID for a little bit. And obviously, the work landscape has changed for many professionals as many people are now spending a great deal of time working from home. So let's take a physician who's spending at least 50% of their time working from home doing telemedicine. Is it fair for that individual to charge their corporation rent? I guess what I'm getting at is this a legitimate way to move some money out of the corporation in a tax-friendly manner?
Yep, I think that we are going to see a lot more people, medical professionals who are incorporated included, being able to qualify for the ability to claim home office expenses one way or the other, whether they charge a rent to the corporation or they claim some sort of home office as an employee
Hmm.
of the corporation. Of course, and I think you hit the nail on the head, is that medical professionals, my clients love to ask me like, oh, I'm gonna deduct my office. It's like, wait. You have to you have to see patients in your home more than 50% of the time. The rules are quite codified there, and I
Uh-huh.
think that this year we're going to see a complete shift. Many with telemedicine. I have to tell you, I haven't um, read the legislation recently enough to be able to make a definitive answer, but I suspect that we're going to see many people that
Hmm.
who otherwise would not have qualified to make these types of claims will.
Ali, you spoke a little bit earlier about loans, and as we wind down the conversation, I'd like to touch upon the topic of shareholder loans. I realize that the rules governing these loans is not totally black and white, but perhaps you can offer a little bit of guidance to our listeners as to when these loans can be used as a legitimate way to move some money out of the corporation, and maybe more specifically, can it be used to make a down payment on a house?
So, what you're referring to is effectively saying, I'm going to take money out of my corporation. I'm not going to treat it as a salary or a dividend. I'm just going to have my company loan money to me, and one day I'll pay the company back.
Right.
So, the interesting point is that if there were no rules against this,
Hmm.
then none of us would ever pay ourselves salary or dividend. We'd say, screw it. We only want to pay 12.2% in the company, and then all the money we take out after that is just a loan.
Right.
So the quick answer is there are anti-avoidance rules or specific legislation that says that loans that are taken out of corporations to certain, I'll speak in generalities, to certain shareholders,
Hmm.
if those loans are outstanding for more than two balance sheet year ends,
Hmm.
that loan becomes income to the person that took out the money.
Hmm.
So, for example, if you take out money from your let's say, assume your corporation has a December 31st year end, you take out money on January 10th, 2020.
Right.
If you do not repay that loan by December 31st, 2022, because
Hmm.
as you remembered, we have to get through 2 year ends of the corporation, that loan would become income to you back in 2020. It actually becomes income to you at the point in time in which you took the loan out.
Hmm.
So I would strongly recommend using this as as a planning tool. It is true that if you need to pull money out of the corporation, you can take it out and not pay tax on it as long as you pay it back by before the second balance sheet date.
Uh-huh.
Of course, there's another section of the act that indicates that you have to charge yourself interest at a prescribed rate. There's an
Right.
interest benefit for the use of that money, but the this section of the act or this concept is fraught with worry. The reason being that when things go wrong, this is referred to as a 15 sub 2 loan. And when things go wrong in this world, they can go really wrong.
Hmm.
And what really wrong means is double taxation. It's one
Oh.
thing to pay 53.5% once, but it's another thing to have to all of a sudden pay like 70 or 80% tax because you made a boo boo and thought we were going to play around with shareholder loans. And
Uh-huh.
the reason that I say that is that if the government thinks that you're doing some funny business by entering into what's known as a series of loans and repayments, whereby
Right.
you might say, oh, Ali, this is great. I'm going to borrow money on January 1st and I'm going to pay it off by the end of the second year, December 31st, and then I'm going to reborrow it again and pay it back and reborrow it. This is not going to fly.
Right.
This is not going to fly. And that's where you get into the risk of double taxation, which really not necessarily meaning 100%, but you can certainly start getting up into, well far ahead of 53 and a half.
Oh
And
God.
it's not a game that we should be playing. And it's not a game that's fun for me as the accountant to try to explain to the CRA auditor as why this is not a series of loans and repayments.
Right.
So yes, it can help in the short term. And certainly if you have to pull money out, often what happens is we pull money out of the corporation and then
Hmm.
sometimes we figure out later, well, what was it? How did I pull it out? Was it a salary? Was it a loan? Was it a dividend? Um, and it is okay. I'm not saying that you can never pull money out. And if you need money out for a short period of time,
Hmm.
go for it. You can pull the money out, you can put it back in, or you can pull it out and then tax it perhaps in the next year as a dividend to clear that loan. I'm just not suggesting that it's not what I would call a legitimate way
Okay.
of trying to efficiently take money out of a corporation.
Okay. And I just have to say that the notion of double taxation is really depressing to me. All right, Ali, so I'm now entering my fifth year of medical practice, and I can say with full confidence that, for sure, in the first 3 years, I did not take full advantage of what my corporation had to offer. So I'd like to finish things off open-ended, and my question to you is, what are some common mistakes that you see new physicians make? Specifically, what can they better do to take full advantage of their corporation? And maybe you can pass on some advice or pearls, if you will, to our listeners.
That's a great question. So the first thing that I'm going to say, which is that some which is actually going to go, I think, against the question you're asking me, but then I'm going to follow it up with a good suggestion. But I think that individuals, medical professionals included, sometimes think that this corporation is a magical being that is somehow going to reduce their tax, their tax burden significantly on a permanent basis.
Right.
Or the other thing that I often hear is that, oh, well, if I have a corporation, I can dump all of these expenses into the corporation.
Yeah.
And the key to know is that just because you have a corporation does not mean that you're entitled to claim more expenses or different expenses. In fact, any of those expenses that you're being able to claim because you're now an incorporated business, you should have been able to claim as a sole practitioner
Right.
on your tax return as well. So
Hmm.
there's not some special reason whereby there's a whole new array of expenses that can be claimed if we're using a corporation.
Right.
And in fact, I think in fact, I, if we're, what I would say is if we're not saving enough money to make the corporation worthwhile, I think in many cases it can be more trouble than it's worth. It
Hmm.
does become a funny concept of, is this money mine? Is it the corporation's? How do I pull it out? Where does it go?
Hmm.
You have to be prepared to put the effort and do the mental gymnastics around it to truly understand
Right.
what the corporation is. But that being said, by all means, if you're making money and you're going to invest it, and you can invest dollars in the corporation that you're going to use to fund your retirement or perhaps leave to your kids one day,
Hmm.
if there's a long runway ahead where you can keep this money in the corporation and you're not going to pull it out,
Uh-huh.
by all means use the corporation to make the investment, because better to invest dollars that have been taxed only at 12.2% or
For sure.
26 and a half versus dollars that have been taxed at 53 and a half. The one, if I can leave you with one tidbit
Hmm.
that I find that escapes some of us, and it can be advantageous in a corporation as well. One easy tidbit is that if we are so philanthropically inclined, if you're a person who's charitable and likes to
Hmm.
make donations,
Hmm.
make sure that the most efficient way to make a charitable donation is to give a gift of appreciated stock. So the beauty of giving, so if you have a choice, you're going to make $1,000 donation. Maybe
Uh-huh.
you're going to make it to the hospital, you're going to make it to a religious organization, doesn't matter who. If you're going to make the donation of $1,000, you have a choice. You could give the cash, fine, but of course it means that you've paid full dollars to earn that cash.
Right.
Or you could give shares of appreciated stock. Maybe back to that investment we talked about before, where you had $100, you invested it, it grew to 1,000.
Hmm.
The nice thing when you give away shares of appreciated stock is that, number one, you do not pay tax on the gain.
Oh, interesting.
You do not pay tax on the gain in that stock, in the appreciation. And two, you still get a full donation tax receipt for the
Wow.
$1,000. So, of course, you're still giving away $1,000. You're still giving away an asset worth $1,000. But if you otherwise were going to sell that asset, you are going to also create a whole bunch of taxable income that now you won't have to create because it's sheltered by way of giving away the appreciated stock. And then the triple nice
Oh boy.
thing is that
Okay.
if you give away an appreciated stock, public stock,
Yep.
from your corporation investment portfolio to a charity. So again, the corporation would not pay tax on the appreciation.
Okay.
The corporation would get a full donation receipt. Um, on a corporation, it's actually a deduction, not a credit. Regardless, doesn't matter. Take my word for it. So you get let's just say the full benefit of the donation as well. But the beauty of it also is that you get a full credit to your Magic Capital dividend account,
Wow.
which, because remember, the non-taxable portion of a gain goes into your capital dividend account.
Yes, that's right.
And when you give away appreciated shares of stock, the entire gain is non-taxable. So that entire gain goes into your CDA. So the beauty of it means you can give the $1,000 away to the charity. You didn't have to pay any tax on the appreciation.
Hmm.
You get $1,000 write-off for the donation, and you can pull $1,000 out of your corporation without paying any additional tax,
Oh my
because
God.
you have the full addition to your capital dividend account.
Wow. All right, this may have just been a little tidbit to you, but this literally blew my
Woof.
mind. Like I had no idea any of this was possible.
And that's something, to be honest, that when I meet with people that they're like, what? And I when I do people's tax returns, when I notice that they're philanthropically inclined, the first comment I make to them is, make sure if you find that you're writing a check for, $1,000, $5,000, whatever the number is.
Right.
I mean, for a few dollars here and there, it's not necessarily worth your while.
Hmm.
But if you're writing a significant check, don't write the check from cash. Call up your broker, instruct your broker to make the donation of stock.
Yeah,
It's done all the time. All major charitable organizations will be very familiar with this, and basically you'll call up the organization and say, hey, I want to make a gift of stock, and they'll say, great, have your broker call my broker. They share
perfect.
information, the stock goes over, and you're done. And you get a donation receipt, and it'll specify on the donation receipt that it was a gift of stock.
Okay, well, maybe that's something that I can do with my Amazon stock down the road.
Yeah, there you go.
Ali, you've given us so much useful information today. I know that I'll have your part of the podcast on repeat so that I can burn some of this information into my brain. I just want to thank you for taking the time to be here today and relaying your expertise to our listeners. I know they'll be grateful.
My pleasure. As you can tell, I'm very passionate about tax and happy to discuss it at any time. I hope this was of assistance to your listeners and yourself.
Okay, there it is, our interview with Ali Spinner from Crowe Soberman. A lot of useful information there on the fundamentals of corporations. Remember, this is probably the first episode of many on corporations. We will dive into more detail later on in the podcast. And if there's a specific topic that you'd like to hear about from an expert, please reach out to me at BeyondMD, that's BEYONDMD podcast at gmail.com. Remember, we are in this together. And remember, if you're ever feeling charitably inclined, if you want to be a baller, feel free to donate some of that appreciated stock. Until next time, when we talk about insurance, take care, everyone. Hope to see you then.